Hey guys, welcome to the Trade Genius podcast. Bob and Phil here. As always, guys, the market is screaming today off of the JOLTS jobs numbers, thinks it's just the best thing since sliced bread. However, if we look at what's really going on with that data and what that implies for the Fed potentially pausing or even cutting rates, this market's going the wrong way. So we're going to tell you what that means. Let's dive into this video.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
All right, Bob. So the jobs numbers actually missed projections, but of course, then the market thought that was favorable because that means that the Fed could stop being so hawkish and go into a dovish mode. But given the yield curve inversion and some of the numbers that we've been showing people in terms of the economic growth slowing, if we look at history, and history rhymes, the market is probably getting a little ahead of itself. What do you think?
Yeah, Phil, I agree with you. So history actually more than rhymes. Once the Fed stops, if it pauses twice or cuts, the market rolls over. It goes from, oh, thank God, that my cost of borrowing is going to go down. The bad news is the tsunami of all the tail from raising washes through for the next 2 years. And I think we're going to roll over. But this isn't just 1 month thing. I think this is like 3-month average where job openings are collapsing. And I saw an article yesterday. It was pretty interesting. Is that if you're in what they call, and I don't mean this derogatorily, if you're in what's called the low IQ business, and it's not just employment, it's also manufacturing without a lot of IP, simple services, and things like that. Those jobs are going to get deflated and destroyed. Mm-hmm. And I think we're starting to see that. What I'm talking about is that if you don't have a job, you're not going on vacation. That's a non-IQ service sector job. Like my daughter went to the store the other day, $50 for 3 non-essential things. Those things go away when you don't have a job. And I think what we're seeing here is the compounding effect. I think the Fed overshot personally. I don't think they understand their lag effect very well. And I think once these jobs go away, companies are always loath to bring these jobs back, Phil.
Yeah, that's right. They stop hiring, right? Then they freeze wage raises, right? And then they start laying off, kind of typically how it goes. There's definitely a softening here. I mean, look at the 3-month moving average we have up here on the chart. And then if you look at this ratio of job openings to unemployed workers, that's going the wrong way. If you're bullish on the economy, probably have a lag in the GDP numbers. We're going to get GDP numbers tomorrow. I suspect they're going to be good because the GDP Now data, which tries to track GDP in real time, is bullish. So we'll probably have another good GDP print. But however, from here on out into 2024, I believe we're going to start seeing a softening in the GDP numbers as well. Primarily, jobs is typically a leading indicator. And so I just think that, data here, the market was favorable to this data because they thought that, like we said earlier as we opened the podcast here, the Fed would start to become dovish. But Bob, historically, and that's the last thing we're going to show these guys, that doesn't bode well for the market longer term.
Yeah, and before you get to that thing too, a lot of people don't understand GDP. When you do an inventory restocking, that adds to GDP whether you sold the stuff or not. Mm-hmm. And so, a lot of that inventory stocking is done now, and you can see it with the shipping and trucking. Both those sectors are getting wiped out, and we're going to probably go into a UAW strike here in the next 2 weeks. And so, it's definitely, quarter over quarter after this GDP print, it's not going to be very favorable. Everything is start pointing towards lowering of economic activity. But to your point, Phil, if you want to throw this last chart up here, this is why we know it's not rhyming. We know this is what happens. And when the Fed pauses, the market tops. We already had one pause, okay? okay, if we get a second pause, the market's going to start rolling over. And if we get a cut, the market definitely is rolling over. The trade that I recommend, Phil, for this, besides TLT, which we re-entered, I said if I got over $96, it's going to 99. Well, it crossed today. We got in a little bit earlier than that because with the dollar dump. I think we're starting to see now positioning into longer term, longer dated treasuries. But the other trade you want to take is if you don't want to be in anything leveraged, then you need to probably shift into something like SH, the short of the SPY, and literally just ride this thing. You can make 20, 30, 40% on a big sell-off over 2 years. I think that's pretty good trade, Phil. I don't know about you in a market that may fall 20 or 30, 40%. So, you don't have to go crazier to make money in a down market. But look at this trade. Phil, I know it's a bit of an eye chart here, but, once they start cutting, we have the 100-week rule in play here twice.
Right. Yeah. So the blue line is the Fed funds rate and the green line is the S&P 500. We just zeroed in on the last two recessionary periods. So you can see where, like Bob was saying, pauses are usually foretelling of a recession that comes. I think we're a little closer matched to the dot-com boom back in the 2000, 2001 window there. And as soon as they started pausing, the market basically topped out. The situation we have now is there's just way more liquidity in the system and way more dollars in the system right now than these previous two episodes. And I think that's why we got this weird sort of pseudo bear market beginning here from 2022, because as soon as they turned the spigot off, we all of a sudden we had all this air under us, right? And it just came down really quickly. So it actually triggered some bear market thresholds. And then we have like this echo rally that's coming back up again. You have to think about it like harmonics or bathtub waves, right? You got a lot of liquidity sloshing around in the system. So even though they're taking liquidity out and backing liquidity out, and there is less liquidity in the system than there was going into the beginning of 2022, you still have these large echo moves that happen. And that's why we're seeing like this run up here again. However, that being said, we're going into a regime as well where the markets have the reverse repo window, which wasn't really a thing in the last two recessions. So this is like a $1.5 to $1.7 trillion slush fund that the banks have. And we also have what Yellen's doing. So the dynamics of those things is actually what's really driving the market now. And that really wasn't the case in the last two recessions. So what we know is that Yellen's going to be issuing more longer term debt. And what we know based on market conditions and how it affects reverse repo and how reverse repo affects the stock market is that when she issues that longer term debt, that is what really sucks liquidity out of the system. That's what happened in the beginning of 2022. She was issuing a bunch of longer term debt, sucked all the liquidity out of the system, and we had a quick pullback. Like I said, that triggered kind of the bear market thresholds in that first half of 2022. We're going into that again in Q4 of 2023, and we're also going to get into that more heavily in 2024 because she's kind of like shot her wad in terms of the T-bills early and kind of got us a bounce here, a nice aggressive bounce, but she can't. It's unsustainable, right? You cannot just issue T-bills. You'll go, bankrupt yourself. Government won't be able to cash flow. They've got to start sticking debt into longer term stuff that they can pay back at a later date, and hopefully bank on the rates dropping into 2024, which I think is what her game plan is. And that way she can issue longer term debt at a cheaper rate, Bob.
I totally agree with you, Phil. It's going to be really interesting to see. And, and the economic cycle now is going to play out. I mean, look at a lot of these companies are going to, they're going to re-engineer coming out of the recession. So I think we're going to just see a long goodbye here.
Yep, I agree. Guys, let us know your thoughts. Do you think that we are in for one final push up and then a rotation lower into the end of the year? How's your outlook on 2024? We would love to hear from you and also hear about what you're seeing in your neck of the woods as well. Thanks for all the comments, likes, and subscriptions to the channel. And please check out our specials over at tradegenius.co. Guys, we'll see you on the next episode. Take care.
Trade Genius.